Guys, welcome to What the Banks Do Not Want You to Know. My name is Connor Steinberg, full-time real estate professional out of Dallas-Fort Worth, Texas. I'm both a real estate investor and a real estate agent. Let's pull back the curtains and take a look behind the scenes of what the bank does not want you to know, right? This is important. Let's look at the 30-year mortgage and see kind of how these numbers operate, because I see a lot of investors as well as individuals, owner occupants, not really knowing what they're signing when they sign the dotted line, and then they wake up in a spot where they're very frustrated because they didn't understand what they got themselves into. Now, there's pros and cons of a 30-year mortgage. I'll talk about these at the end, and I'll give you some reasons why you want to do these, as well as what you could do instead and why you may or may not want to do this. But if you're not using this wealth creation tool to create wealth and you're using it to create cash flow, and that's what you're trying to do is only make passive income, but you're turning your properties over and selling them quickly, this is maybe not the strategy for you, and this is going to make sense as I go through this. I see a lot of investors mess up. Let's take a traditional loan. This is an actual property that an investor reached out to me and basically said, Connor, I have the potential to get this loan. Is this a good deal? And I asked them what was their intended goal with the deal. Was it to live off the cash for the day and create passive income? Or is your goal to create wealth tomorrow for your retirement plan and pass down generational wealth to your family line going generation after generation? So a lot of that has to play into what your long-term or what your real goal is when you go buy a real estate piece, or where you go buy a piece of property as a real estate investment. $200,000, 3.99%, 30-year loan. Now, this is important to understand, guys. If you do this loan, your loan amount is $200,000. Your 30-year interest on that $200,000 is $143,324, creating a total loan over 30 years paid to the bank before your house is free and clear of $343,324. It's a lot of money you're paying to borrow that money over 30 years. Now, if this is the only way you can buy a house, sounds like a pretty good deal, right? Now, it's important to understand when you buy a house, you're gonna have a promissory note, a deed of trust, and a deed. The deed is the ownership of the property. The deed of trust is a security instrument. So in case you don't make the payments, the bank can take the property back, and the promissory note is the IOU. And you're gonna have what's called a P&I payment, principal and interest. And this is what's important to understand, which a lot of people that have a loan really do not understand this, which blows my mind. It's like, how do you borrow this much money and not understand what you're doing? So this is what this P&I payment would be on this particular property. $289 of principal, $665 of interest, P&I total, $954. Are you guys seeing what I'm seeing? $665 of interest, which is over double the amount of principal. So in the beginning, you're paying over double in interest to the bank than what you are actually paying down on the property that you own. It's gonna take a long time if this doesn't change, right? But good thing it does. Over the years, these are gonna flip-flop. Like, have you ever seen one of those little things where you put the sand in, you turn it upside down, and it starts to switch over? Here's what happens every year. The amount of interest going drops, and the amount of principal paying towards the loan being paid down goes up. It looks like this right here. The first 7 years is a front-loaded, interest-heavy part of the loan, right? You're paying a substantial amount of interest in. Let's take a look at this. Here's the first year payment. You're gonna have $7,904 in interest paid, $3,540 in principal paid. Next year, $7,760 in interest paid, principal $3,684, $7,611, $3,833. Now go on the internet, guys, find an amortization calculator or a website that does this, and just kind of play around with this, because this is interesting. Look at what's gonna happen over the first 7 years of that loan. $52,095 in interest is being paid, but your total interest paid over 30 years is $143,324. This is what the bank does not want you to understand. If you divide $52,095 into $143,324, that is 36.3% of that 30-year loan, a third of it or more being paid out in the first 7 years, right? So in less than 25% of the loan's overall length, you're paying out over a third of it in interest. Who does that benefit? Does that benefit you, or does that benefit the bank? And now you understand why the banks are the biggest building in every major city. Now, what's interesting is at about 13 years in, the amount that you're paying in principal and interest are gonna be roughly the same. So you're always gonna pay $954, except these numbers are gonna switch over time. So let's take a look at something here that's interesting. What if you were to take the same loan, $200,000, 3.99%, but instead of doing a 30-year loan, you did a 15-year loan? Right here, look at the interest paid. $66,000, 107. It's literally half, right? It's half of the interest that you pay on a 30-year loan. But you're still gonna own a $200,000 house free and clear. Hopefully there's equity in it and appreciation by this time. But this is why it's important to understand what you're doing. Are you an owner occupant living in the house? Are you an investor owning the house for an investment purpose to create today cash flow? Or are you an investor trying to create equity and get to a free and clear property as quick as you possibly can? Now here's what the bank understands, which most people do not. National statistics used to be around 7 to 8 years before the average person would sell their house and move into a different one. So isn't that kind of ironic that almost all your money's front loaded in the first 7 years? I don't know. What do you think, right? Now you're seeing more statistics say it could be more like 11 to 13 years. But even then, at 13 years, if you're moving, you just got to where you're basically paying as much principal as you are in interest. So what does this mean? It means that if you take on a 30-year loan, keep it for 30 years to get the benefit from it. If you're taking a loan on and you're selling it within the first 3, 4, 5, 7, 8, 9 years, you're paying mostly interest. You're making the bank rich and you're not really paying down a lot of principal. Unless you're getting big appreciation, this is not very beneficial for you as an investor, right? Is it? So it's important to understand. At a 15-year interest or a 15-year loan, you're gonna have a higher P&I payment, which is why a lot of investors avoid this because their cash flow is smaller. But when you talk to seasoned real estate professionals, they're gonna tell you that a rental property is an equity play, not so much a cash flow play, which most investors think getting into real estate rental properties is more of a cash flow play for passive income until you really own a lot of them and you realize it's not so much passive, it's cash flow. But you need to ask yourself, what is your goal? Is your goal to build a nice retirement plan for yourself? Because let's take 143,000 divide by or minus 66,000, take that difference and times it by 10 houses, 20 houses, 30 houses. So if you're making income through flipping houses, selling houses, working a 9-to-5 job, another business, whatever you're doing, and you don't need the cash flow to live off today because you provide for yourself in another way, would it be smarter to go with a 15-year loan versus a 30-year loan? Because it takes a lot of cash flow properties on a 30-year loan where you're making $300 a month just to get up to where you can live off that income, right? So it's important to understand, guys, what your goal is with this loan. Now, is this a ripoff? I don't know. What do you think? You're voluntarily going down to the bank to acquire a piece of property that you could not acquire in the first place. So it's all about how you want to think about it. You decide what your strategy is, but if your strategy is to get into a property, own it for a few years, let the appreciation go up a little bit, if at all, and then cash out. I see a lot of people do this. They own a property for 4 years and they sell it. Why would you do that? Where is the benefit of doing this? The ability to create wealth through real estate is a very powerful tool. You should own these properties long term to create wealth, not to turn them and flip them. There's other types of loan products for this. And there's other ways to acquire properties to get in and out faster, to capture the equity. So it's just something to think about, guys. If you've never been in the business and you're thinking about this getting in, should I go with a 15-year loan or a 30-year loan? Or if you're a homeowner moving into a house and you're representing homeowners to move into a house, they need to know if they're moving into an area that this is what they're going to be doing. Why would you go and get a 30-year loan if you're going to be moving in 5 years? So it's just something to think about. When you look at this loan, before you go sign the papers, think about where the money's going and how long you're gonna be in the property and what your desired end game is, and make your decision based off that going forward, guys. I hope you like the background on this 30-year loan video, and subscribe to the channel, hit the notification bell as well. It's gonna notify you when future videos come out, and I'll see you on the next video.